Welcome again, everyone, and welcome to those of you that are just joining us. My name is Sandra Barba, and I'm the Marketing Events Specialist here at Certent, and your moderator for today's webinar on Timing is Everything, Early ISO Exercise. Before we get started, I'd like to just go over a few housekeeping details and a little disclaimer. Chuck, if you could just move on to the next slide, that would be appreciated. So I just wanted to take a moment and advise our participants or anyone viewing this webinar that there is no investment advice being rendered. SFG is an SEC registered investment advisor. Certent and SFG advise participants to seek advice and counsel from your financial and tax advisors. And now I'd like to go over just a few housekeeping items. You should be able to hear us through your computer, but if you wish to hear our presentation on your phone rather than in your computer, please select the telephone option under the audio panel located on the right-hand side of your webinar control box. Also located on the right-hand side of your webinar control box, you'll find a chat box in which you can type and communicate with our presenters or myself at any time during the event. Just type your question in the box, and we'll make sure to address it as it comes in or at the end of the presentation. Today's webinar is being recorded. A recording and PDF copy of the presentation link will be sent to you in our thank you for attending email within 24 hours of this presentation. Also located in your handouts portion of your audio panel of the webinar control panel, you do see the PDF presentation already loaded in there. You can go ahead and download that at your discretion. We will be conducting a brief survey at the end of the webinar just to get a little bit of feedback on other learning topics of interest that you might appreciate us doing in the future. And now I'd like to go and take a moment to introduce our presenters. Joining us this morning is Chuck Steege. Chuck is president of SFG Wealth Planning Services Incorporated. Chuck helps executives unlock the value of their varied and complex stock-based compensation plans and equity awards by combining his experience and training as a financial planner and equity plan professional. A graduate of Gordon College, Chuck has been providing advice since 1985 and has been a licensee with the Certified Financial Planner Board of Standards since 1990. Chuck is a Paladin Registry 5-star rated advisor, is a licensed practitioner, a member of Kingdom Advisors, along with being a member of the National Association of Stock Plan Professionals. Joining Chuck this morning is Don Gillotti. Don is the Senior Vice President of Sales for Certant's Equity Management business. Don has held sales, marketing, and management positions for over 25 years with a focus on equity compensation since starting with CMS in 1999. He has led top-producing national sales teams at Certent and Transitive. Chuck, Don, thank you for joining us this morning. And now I'd like to go ahead and turn it over to Chuck.
Well, thank you, Sandra, and thank you, everybody, for making time available in your very busy schedules. This is a topic that we get very jazzed about because it does mean significant tax savings, and it is an area that is not widely addressed for your participants, for your senior execs. What we're going to look to achieve today is a deeper understanding and ideally a value add to you in terms of your role as plan administrators, as HR heads, as leaders around some of the considerations that go into considering doing an early ISO exercise. We're going to talk about the current economic climate, what we're seeing in terms of the capital markets, the general move towards the inertia in the economy. We're going to talk about ISOs. Many of you are well versed on them. We're going to be reviewing in detail some of the concepts around ISOs, how they function, what is an early exercise, some of the conditions and timing. We are also going to be looking at the capital gains tax treatment because the biggest driver behind doing an early exercise is ultimately achieving capital gains. As you all know, ISOs are statutory options, and so they do present significant tax savings. And the other aspect is what kind of candidate, who of your employees and your participants should be considering doing an early exercise. What are some of the tax benefits and some of the side benefits of doing this? But then there's also risk. There is a point where doing an early exercise, while it may result in tax savings and some timing benefits, there are some risks and crossover points when it comes to the company's stock price that need to be considered. So what we wanted to do is talk about what we're seeing in terms of the strength in the capital markets. And Don, would you go ahead and address some of the concepts around what we're seeing?
Yes, thanks, Chuck. Dow 20,000 is the first item here, and I'm sure many of you realize that the stock market since late last year and into early this year has been hovering at or around all-time highs. And that does matter. It matters with ISOs because public market prices affect private market valuations. Many private companies use comparable publicly held companies to figure out what their own stock is worth and make decisions based on the value of their private stock. And those rising valuations can generate some optimism and can get employees and executives thinking about liquidity, thinking about transactions, and perhaps that they should make some decisions with regard to their ISOs. So that's what the capital markets impact can be. IPO activity is another one, and it goes right along with these high valuations in the capital markets. One would think that IPOs should pick up this year, and they have to a degree with high valuations in the stock market. And if employees believe that their employer is going to go public, they may want to start the ISO clock ticking, as it were, and we'll cover that coming up on exactly how that works. But in an effort to get favorable ISO tax treatment, they may view the early exercise as a viable way to get some tax preference on their ISOs that their employee has granted to them. Then CEO confidence. So CEO confidence is up. At the time we went to press with this, it was 67% expecting better economic conditions over the next 6 months, a big improvement over last year. And Chuck, let me bring you back in here because you work with executives and CEOs on a daily basis in your practice. So anecdotally, what are you hearing? Are you hearing some things that are consistent with these statistics?
Yeah, I would say that optimism is definitely rising. You all are reading the financial press and are seeing what is happening in terms of earnings multiples increasing. So we're seeing a general trend towards confidence. I mean, I think that's been widely reported, and with that confidence, with the optimism that's growing, many folks are beginning to think about, okay, if my company did end up going IPO, you know, what would be the benefit of considering doing an early ISO exercise? So they're definitely thinking about it. If optimism was not embedded in the thinking, then quite honestly, folks wouldn't be considering early ISO exercising.
That's right. And so if CEO sentiment is better, that may also hasten a move to the public markets for financing and potentially a payday for the board and senior executives and also the employees of a company. So confidence certainly matters. And then the last one here is M&A activity and an expectation that M&A activity will continue. And, you know, there's still an awful lot of capital out there on the fence, venture money, PE money, and even more traditional money out there looking to get to private companies as an alternative, mutual fund companies, et cetera, delving deeper than ever into privately held companies. And long-term interest rates have moved a little, but not much. So lots of capital available to make deals, and that doesn't look like it's going to change significantly in the near term. And the M&A activity can create a forced exercise. So people can sort of get cashed out of their ISOs, depending on how the grant agreements and plan docs are structured, without really having a choice. And so again, there may be an effort to try to beat the ISO clock and get favorable tax treatment if folks sense that there is a transaction coming of some sort where they're going to be cashed out of those ISOs. And that would be something that at least employees who understand the rules would be thinking about.
And
so let's move on. And oh, go ahead, Chuck. Thanks.
I was just going to say it's no secret that the confidence level is rising because the Federal Reserve is contemplating 2, if not 3 more interest rate increases between now and the end of the year. And so I think that's a clear statement of the expectation of the inertia with the economy.
All right, so let's go on and take a look at the treatment of ISOs. And I'm sure many of the folks on the call are familiar with this, but under Section 422 of the Code, these qualified stock options or incentive stock options or ISOs offer a tax benefit in the year of exercise. However, what you won't find in Section 422 is a statement on the AMT or the alternative minimum tax, which is a big part of what we're talking about today, and one of the things to watch out for that perhaps people aren't thinking about, employers, plan administrators, and certainly employees. And then there's a holding period. So in order to access that favorable tax treatment in an effort to get capital gains treatment on all of the gain from an ISO, the holding period is required to be at least 1 year and 1 day from the exercise. And so if people are able to exercise early, they are able to start that 1 year and 1 day holding period earlier to try to get to the point where their gain will be full capital gains treatment. Conversely, if they don't make the holding period and they exercise and then sell out of a position or sell their ISOs, you have a disqualifying disposition. So post-exercise shares are sold within the 1 year and 1 day period, and that will then generate ordinary income rather than capital gains, and that will be less favorable from a tax standpoint for the employee or executive. So then the capital gains rate then would be either 15 or 20%, but it's almost always therefore going to be lower than ordinary income, and that variability in the capital gains rate will depend on the ordinary income of the taxpayer. And what about the payroll taxes, Chuck? Can you come back in here and just talk to us about that for a moment?
Sure. So obviously, if there's a disqualifying disposition, an employer would need to pick up on that event, or the individual executive would need to report it properly. I was just going to go back to the first point about the fact that with ISOs, AMT is not easily understood, and I want to underscore that not every CPA delves deep into this. This is a highly specialized area, and in our practice, we do see folks come in the door that maybe, in fact, did an early exercise, but the AMT tax calculation was never reported. We had a situation a couple of years ago where with a West Coast IT company, an analyst had heard over the water cooler that she ought to be doing an early exercise, which she did. She didn't know why she did it, but when it came to reviewing her tax return, it was not properly reported, and she ended up needing to go back and amend her tax return. So her CPA was not well-versed in how to deal with this, and so it is a highly specialized area, and it is something that, quite honestly, it needs to be filed properly, because as you all know, you're required to file for the company the 3921 when there is an ISO exercise. But most plan participants simply don't understand how this is to be filed and filed properly.
And Chuck, while we're talking about early exercise today primarily, isn't it a fact that an exercise of vested ISOs or an on-time exercise can also create an AMT liability for an individual taxpayer?
Most definitely. Whether it's early or whether it's ordinary way post-vest, it is an AMT preference item that needs to be filed on an individual's tax return. And under 6251, a CPA that is worth their salt and knows how to report it properly would have to report it on that form. So most definitely.
Yep, so our point here is don't give him advice, certainly tax advice or financial services advice to your employees. Direct them to their financial advisor and accountant, and if it's ISOs, you really want to have an accountant or tax attorney that's very familiar with the ISO rules and in particular the AMT tracking because there will be a liability potentially, but also a credit back potentially when the shares are disposed of. So let's talk about the early exercise and just define it a little bit since that's the focus for today. And with ISOs, many companies, not all, offer early exercise as an option. It may not be well understood by the employees, but you will find it and they will find it in the plan document and grant agreements if it's allowed. Again, that doesn't mean that all ISOs offer early exercise. It's based on how the company drafted the plans and how the board approved the plans, et cetera. These privately held companies could be pre-IPO. However, early has nothing to do with their life cycle and the point in the life cycle that the company is in. It just simply means prior to vest. It has nothing to do with where this company is or whether they're truly pre-IPO or not. Early simply means prior to vesting. And there are, in fact, multiple benefits, but also, like many other things, several impediments. So you've got to be careful here as the employer issuer to understand all of these issues and all of these rules, but again, refrain from giving advice or even anything that could be construed as advice to your employees. Some of the things maybe that will be a little bit more straightforward and that are laid out in the plan docs and grant agreements that you can talk about and that you'll get questions on, for example, are terminations. If I do an early exercise prior to vest and I term for various reasons, what happens? Acquisition of the company is certainly a big one as well because that can happen and does happen quite often with private companies. So again, if I've done an early exercise and then the company gets acquired, what happens to the shares that I've purchased? What is my tax treatment at that point because it's sort of a forced disposition? Those are kinds of things that perhaps you could talk about, but we definitely want to steer clear of giving advice. All right, let's move on, and we'll talk a little bit about liquidity, I think.
That's exactly correct. And obviously, when you're considering doing, or your participants are considering doing an early exercise, liquidity becomes paramount because as you know, they're going to have to pay the strike price. As we've been talking about, the ISOs are subject to AMT, and so AMT taxes will be due for the year in which there is an ISO exercise on the bargain element, the in-the-money value. Depending on where your participants reside, there could be state or local taxes on that, even though federal will be reported as an AMT item, but that is a consideration. And then Donna's touched on the AMT credit carryover. We could really go down a rabbit trail when it comes to dealing with AMT, but this is a factor. This is something that a CPA will need to track from 1 year to the next, where in the first year, as I mentioned, the 6251, that is the form that's submitted in the year of exercise. But then in a subsequent year, if there is a recapture or a credit, that's recovered on Form 8801. But again, in our experience, not every CPA is knowledgeable about how to best track this, how to best report this, but it is important. Liquidity is really critical. And again, I go back to the example of our client of a couple of years ago. She made an early exercise, but didn't realize it was improperly reported, had to come up with additional AMT dollars, and she, quite frankly, didn't have those resources. One of the risks is that if there is a need to generate money, not so much for the exercise price, because presumably if it's an early stage company, the strike price is going to be low. It's more the AMT taxes. And it could be that there are additional capital gains or tax events that are created if there is a liquidation from your participant's individual securities portfolio. So that kind of runs the risk of compounding the problem. It's difficult, really, for an early exercise to be done on a cashless basis with a private company because of the fact that the stock is obviously not being traded. There are VC firms that look to provide resources, but we would say it's strongly advised that your participants go into that arrangement with both eyes wide open, because oftentimes that VC firm will take a very large percentage on any future appreciation when that company goes public. And again, if there's somebody that's in a desperate situation of not having liquidity, they need to be very careful about what they're agreeing to. Most executives, well, most senior executives really should understand the concept of early ISO exercise or early exercising, and they're a little bit better read on this. Don't assume they all do have knowledge, but I would also say that where there are companies that reach pretty deep with ISO grants, your participants really need to have a better understanding around how these work. So what we'd like to do is move to an example of what this would look like. And Don, you had asked a couple minutes ago about the normal way ISO exercise, which is really represented here. So we're assuming a company issues ISOs on January 1st of 2014 at $1 a share, 10,000 shares. Your participants don't need to do anything the date of grant. 3 years later, there's vesting. We'll assume it's a cliff vest example. The company has determined that the stock price is $20 at the time of vest. Here again, your participants aren't going to need to do anything at time of vest. But let's say that your executives did decide to make an exercise at $20 a share. Obviously, the difference between the $20 a share and the $1 exercise price, that's going to be subject to taxes. There's a cost to them of $10,000 for the exercise, and ideally they hold for the year and a day period. I will say that with an early stage company, it's oftentimes very difficult to get a ascertainable or determined valuation per share price, but that becomes very important in order to have this tax event properly reported. There is no tax event on the day of exercise. However, The surprise comes April 15th of the next year, where that gain is subject to AMT reporting. It is a preference item on 6251, and again, your participants shouldn't be surprised by this. If they're, if they're made aware of that risk, it's important that they go in with both eyes wide open. And again, I mentioned that the preference amount, the gain is subject to AMT and potentially state and local. So fast forward to 1 year and a day later after exercise. In between, the company decides January 15th of 2017 to go IPO. The stock price enters the market at $20. Your participant doesn't need to do anything, but presumably there has been a lockup period that has been exceeded, and the options post-exercise have been held for at least 1 year and 1 day, and then sold at $40 a share. If they are post the lockup period but not post the 1 year and 1 day, as you know, the ICEs become disqualified and they then become subject to ordinary income taxation. But assuming they did this properly, they held for a year and a day, they're ultimately going to realize either a 15 or 20% long-term capital gains tax on the $39 per option differential, and that would be some significant tax savings. So let's move to another example, which would be an early exercise example. Same general set of facts. The grant was made January 1st of 2014 at a stock price or a strike price of $1. But in this case, the early exercise was done 1 year later in 2015, when the company's ascertained per share stock price is at $5. Well, it is the $5 differential that then becomes subject to AMT. There's no tax at the time of exercise, but here again, April 15th of the year following, that differential has to be reported for AMT tax purposes. And then, of course, the vesting continues under the normal schedule of the 3-year cliff, and in which case, at the time of vest, there's a $20 per stock price vesting price. But your participants don't need to do anything at that point. There's no taxable event other than them maybe needing to track for AMT tax purposes their cost basis in their shares. But because they did an early exercise, they started the clock ticking sooner. And again, if the company goes IPO on January 15th of 2017, stock price at 30, the lockup period has been presumably exceeded, but the sale is able to occur 6 months prior to the previous example that we gave. So they've gained some ground, timing is everything, and they freed up the ability to sell their shares because they've held them 1 year and 1 day, in addition to selling after the lockup period. And if they're not careful and they sell within the year and a day, even though they may be past the lockup period, obviously the in the money value will be disqualified and subject to ordinary income taxes, which here again can be hugely significant. So ideally, what we like to do is, in our practice, is get executives to a place where they have the ability to convert to ultimately long-term capital gains tax treatment at either 15 or 20%. So really what an early exercise does is it saves both time and money. And exercising early with the example that we provided means the ability to sell 6 months prior, but it also means tax savings. If there was an exercise and then a subsequent sale within 12 months and 1 day, with this example, it would create ordinary income taxes close to 40%, and we just apply that rate at $154,000 on the gain versus something significantly lower in the way of either a 15 or a 20% tax rate. So we are talking about significant tax savings. Again, we tried to provide an example of what would be an early stage pre-IPO company with a lower stock price, exercise price, and then ultimately, once the stock gets listed, what this would look like for your participant. So we've talked about all the benefits and the tax savings, the timing benefit. What I'd like to do is turn this back over to Don, who's going to address the risks of doing an early exercise.
Okay, thanks, Chuck. And there are risks. And an early exercise, or even any exercise of stock options, at the end of the day is an investment. And like all investments, or most anyway, return is not guaranteed, and past performance does not guarantee future results. So you have some things to consider. Even though stock options are very appealing, and many of us work in employee equity, and we think of it as part of overall comp and benefits, there is an investment being made. People, employees, and executives are going to commit their own capital to the company. And in many ways, it's not all that different from investing in a public company in that there is the risk of loss, and you don't have the benefit of as much disclosure from a private company, particularly if you're not that far up the org chart and in the know about the company. And, you know, the company may not have had as rigorous an audit, for example. It may never have even been audited. You may be dealing with a company in your employer that's only had reviewed financials, for example. So employees need to be cautious and realize that while, again, it's part of compensation, they're making an investment in the company, and the valuation can go up, which is great for everybody, but it can also go down. And that brings us to number 2, which is the risk of stock price decline during the holding period. That can cause some taxation trouble and get you into this risk of owing tax on phantom income. And Chuck, maybe you could just touch on that one for a second, how that works if somebody does the exercise, but then the valuation declines. I mean, do they have any sort of tax recourse?
Well, it's very difficult to get the tax recourse. We can all harken back to the dot-com era. ISOs were widely issued. A lot of senior execs did early exercises. They ended up reporting the AMT, but then within a very short period of time, the stock price went down, and they were left holding the bag, where they ended up having essentially phantom income and nothing to show for it, and certainly nothing to sell to come up with tax dollars. So, yeah, this is a huge risk, and one that your participants really need to be clear on before they enter this type of a transaction.
And then next, if there is a planned IPO, it could be delayed or canceled. This can happen for any number of reasons. Valuation is often one of them, though, where the company's value can be affected by the overall markets, by the particular sector in which this company operates, or just what's going on with the company in particular, a change of heart by ownership. Whatever the case may be, though, is if the employees are making decisions based on the fact that they think the company is going to go public and they're going to have liquidity and they want to get the most favorable tax treatment possible, there is a chance that that may not happen. And so it's another variable in the equation that everybody really top to bottom in the organization needs to be thinking about, particularly if this is the only path to liquidity. There may be other paths to liquidity depending on the company that they can access, but if there aren't, then there's risk involved here with going ahead and doing the early exercise. And then the last one is if the participant is no longer with the company and is subject to stock repayment. And this is where people need to be advised to read the plan docs and grant agreements, and I would speculate that many employees don't actually do that. But you want to encourage your employees to do that and understand what happens. Particularly, it should be everyone at all times in an ideal state, but particularly if they're going to engage in an early exercise and understanding what the ramifications are if they separate from the company, so that everybody's on the same page and you avoid any sort of legal trouble or finger pointing or any of these kinds of things you would seek to avoid wherever possible. Anything there you want to add, Chuck?
Well, I just want to go back to item 2 again, because the biggest question that we get from our clients when they do an exercise, again, I know we're talking about an early exercise, but with a regular way exercise is how do you figure out what your crossover point is? If after making the exercise the stock price drops, there is a point where whatever tax benefit you think you would have realized or expected to realize, you would not realize if the stock price continues to drop. So it's really important to determine that trigger price where there is a crossover, and again, this requires a lot of planning and a lot of forethought, and there shouldn't be any surprises to your participants.
And Chuck, that's where a financial advisor or a CFP or somebody like that that's objective and can do modeling would probably be able to help people figure out that crossover or perhaps break-even point where a decline in price of the stock can be tolerated to a point, and beyond that point the tax savings are wiped out, and it's just not a good idea.
Absolutely.
So speaking of that, in our recommendations to mitigate risk, again, steer your participants to a financial advisor, and not just any financial advisor. It's got to be an individual that understands employee equity, and in particular understands ISOs, and it's pretty specialized, and many of them do not. Looking at the exercise or early exercise, like with any other investment, assess company strength, liquidity, whether the early exercise transaction makes sense, and most importantly, making an eyes wide open, informed decision, understanding all of the ramifications of it, many of which we've laid out already, but tax being a big one, potential tax liability before any liquidity, and separation from the company, and also an acquisition. Those are some of the big ones. Again, encourage your employees to do this, and be sure as professionals yourselves that you're familiar with the plan documents, the grant agreements, understanding if early exercise is in fact available, and what happens again in many situations, but here if someone leaves the company for different reasons, what are the ramifications of that? Understanding that crossover point that we just touched on, because there is a point where the ISO 422 gains will be wiped out by a decrease in the price, and that's a calculation that really can be figured out. There's not too many variables, but you'd want to encourage your employees and executives to get some help figuring that out from somebody that understands it and is objective in making that decision. And have a strategy in place to mitigate potential value or risk of loss. So, you know, what's going to happen if the stock declines, if perhaps the liquidity event does not occur and there is no alternative market or interior market to which you can access liquidity. Those are all kinds of things to be thinking about. And our major message through the whole of today is to direct your participants to the financial advisors, tax professionals, etc. And if you are communicating with them too, we think it's a good idea to have as much of this in writing as possible, because I think it's fair to say, although it might be a little pessimistic, but I think it's fair to say that in many cases if something goes wrong, it's not going to be the employee's fault. It's going to be somebody else's fault no matter what happens, particularly if it's an unfavorable outcome for the employee. So you want to avoid giving advice of any kind, and whatever the communications are, keep a good written record of that.
So I know we're talking about risk here. We have worked with a CEO of a private company. Now, granted, it was a non-qualified option, but what message does it convey when an executive or one of your participants is willing to do an early exercise to put up their own capital? It says that they are, you know, essentially looking for the longer term, and that's a very positive thing. But again, when we're advising our clients, we're strongly recommending that they need to consider measured risk in that decision.
Great. Thank you so much, Chuck. Before we jump into our question and answer session, which we do have some great questions that have come from the audience, and as we discuss the additional resources that you see listed on your page, if you do have any questions for Chuck or Don, you can go ahead and submit those in the chat box. So in the chat box, as I was mentioning, you should see some links listed there in your chat box on the SFG blog. You can go ahead and visit SFG Advisors on their blog page, get some more information, get a little bit more educated from the SFG white papers, or also jump online and visit our Certent Insider blog. So you should see those links embedded in your chat box. Also in the handout portion of your webinar control panel, you'll see our Certent Capitalization and Equity Compensation for Private Companies data sheet. You could go ahead and download that at your discretion, and the PDF slides of today's deck. So Chuck, we did have a question relating to AMT and early exercise, and maybe you can provide a little bit of clarification around this. If there is no spread on exercise, or if the shares are sold in the same calendar year, then AMT doesn't apply, correct or not correct?
Well, if there's no spread at exercise, obviously there's no in-the-money value. There's nothing to report in terms of an AMT event, so that is correct. So you know, it's a good point, and the questioner brought up you know, something to consider. You know, typically when somebody is doing an exercise, they are having to report AMT. There typically is the company is growing. Or is expected to grow, and the per share amount has increased at the time of exercise. And I might add that there does your participant really needs to make sure that they're clear on what that per share exercise price is, because we've had situations where you know, with a private company that information is not readily provided. So again, they would want to be going in with eyes wide open around what that per option or what the prevailing stock price is. But good point.
Great. Thank you so much, Chuck, for clarifying that. I do have an additional question. From a plan administration perspective, what are some of the considerations, Don or Chuck?
Don, you want to take that one?
Well, I mean, I think the primary one we've talked about, which is really be a student of your plan documents and grant agreements and understand everything about them. Certainly early exercise because it can be complicated and risky, but understand as much as you can. And then wherever possible, go get technology or services that can help you deal with rules-based processing. Because, you know, we're talking about IRS code here. It's very regimented. There's not a lot of room for interpretation, less so than even in the accounting guidelines. And so the next best thing you can do, again, is go get software or services that are going to help you automate this as much as possible, do the rules-based processing where you can program in, you know, an ISO, call an ISO, have systems that will catch, you know, holding periods and 100K rules and all of these other things that we deal with in employee equity, but particularly on the ISO side where I think it gets as complicated as anything else.
Thank you, Don. We do have another additional question that relates around tax treatment between private and public companies. The question states, is there a difference in tax treatment if the liquidity event is a merger or acquisition where the private company is being acquired by a public company?
That's pretty technical, and I appreciate the question. I would be happy to address that one offline. I'm not a corporate tax attorney, so I don't know how that would actually be treated, but I'd be happy to, and I'm sure Don would follow up if the individual that raised that question is willing to provide their contact information.
Great. We will get that message out to you, Chuck, and address that question offline. Thank you so much. Another question, what economic risk would exist causing an executive not to make the exercise? Chuck or Don?
Yeah, and I would say the uncertainty around the future expectations of the company, if those uncertainties are huge, you know, you really wouldn't want to create the taxable event, create phantom income, end up reporting and paying taxes on something that is not realized. If the optimism is there and the expectation is that the company is moving forward in a strong way, then that would be the reason to do it. But if there's skepticism, then it doesn't make sense to do an early exercise.
Great, thank you. Now, there was a mention that the current economic climate as being a factor as to why it might make sense to do an early ISO exercise.
Don, you want to address that one?
Yeah, this is Don. I'll take that one. You know, we weren't necessarily advocating that current economic climate means folks should do that, but we were saying that that's what people might be thinking about, and they might be thinking along those lines because they see a liquidity event coming. They see an IPO coming, and they want to beat the clock on Section 422, or they see an acquisition coming, which will generally create a forced exercise and disposition all at once and put you in the world of ordinary income and keep you from the world of capital gains and lesser taxation. So it's all about optimism. And while the economy is not roaring by any stretch right now, the stock market has been. So I think the economy, it's all about what we think is going to happen. But the stock market right now does affect valuations of private companies because, as we said earlier, they do use peer public companies to figure out what their stock is worth currently.
Great, thank you. We do have an additional question. If you do an early exercise, leave the company, and they repurchase your unvested stock, can you get some of your AMT back for those shares? I love the chuckle.
Yeah, again, I know. Again, we're delving pretty deep into tax treatment and how all of this is reported, and I would just say that's a that's a unique question, and you really would want to get with somebody who can do a deep dive into that. So that's a unique factor, and we hesitate to address that one over this webinar at this point. But a great question, and again, we can take that one offline.
Great. And if
some of these questions just require some more detail, like the first question on the ISOs, private company acquired by a public company. The answer is it depends. It depends what's going to happen with those ISOs. There's really no way to answer that question without understanding what's going to happen in the overall acquisition and what the capital structure is going to look like and what those people that had ISOs are going to have. Are they going to have, are they going to get cashed out of those and that's it? Are they going to get public company stock instead of the acquirer? So many details there that, we would need to know to answer those questions.
Great. I have an additional question, Don. This is a little bit more specific to Certent. Does Certent handle the tax accounting for early exercise with NSOs? It may create a deferred tax liability instead of the typical deferred tax asset.
If we're talking corporate taxation and non-qualified stock options, the Certent system generates a deferred tax asset during the service period. So using a corporate tax rate during the service or vesting period or amortization period, the system accumulates DTA until settlement occurs, which with an option is going to be exercised, and then at exercise, it reverses out the DTA because you no longer need to carry the asset and gives you the journal entries for all of that, including the entries at exercise, getting that DTA off the books and giving you the entries, including the deduction that's going to go on the corporate tax return, and supporting detail behind all of that, where you get rolled up journal entries as well as entries for each and every exercise that occurred of those non-qualified DTA generating options.
Great. I love the questions that are rolling in from the audience. We do appreciate it. And just a reminder, if for some reason after the webinar ends and you do have additional questions, listed on the webinar viewer now is Chuck and Don's information on how you could reach out to them. You can visit sfgadvisors.com or you can visit www.certent.com. You can go ahead and email Don at don.gillotti@certent.com and Chuck at chuck.steege@sfgadvisors.com. We did have another question, Chuck, and maybe you can address this either online now or we can take this offline. Do I need to file a 83B election if I do an early exercise?
Generally, that's a great question. Generally, 83B would be best used for full value awards, for restricted stock awards. And 83B could be filed on an ISO, but I guess the question is, what's the point? It is not common, and in the research that I've done, it's just not widely addressed within the literature. But again, 83B is more typically best applied to restricted stock awards and not ISOs. But great question.
Great. Thank you so much. And it looks like that's all the questions that we have for today. Again, just a reminder, if you do have questions, please feel free to reach out to Chuck or Don. And so I just want to thank Chuck and Don for your time today. Attendees, thank you so much for joining us. Just a reminder, we do have a survey at the end, so if you could just go ahead and address that, it would be appreciated. Don, Chuck, thank you so much. Everyone have an excellent day.